Hello students! At this point, I have generally covered the lesson objectives of each of the 8 lessons within this course. Now I will provide content based on the textbook's objectives, which are similarly highlight important concepts from each chapter. Today's objective is describe the various ways that firms raise capital and identify the pros and cons of each method. This live lesson focuses on textbook pages 429 through 432. Typically, a business owner starts a business with his or her own cash. When current sales revenues are insufficient to pay for expenses, firms must utilize other sources of funds, such as owners' savings or banks, private outside investors, and bonds sold to the public. We will discuss 4 ways to provide funding: secured loans for equipment, working capital and unsecured loans from banks, angel investors and venture capital, and sale of corporate bonds. In a secured loan or an asset-backed loan, the borrower guarantees repayment of the loan by pledging the asset as collateral to the lender. If the borrower defaults or fails to repay the loan, the bank can take possession of his or her assets and sell them to recover the outstanding debt. It is important to note that in the 2007 through 2009 recession, assets from loans defaulted by businesses and homeowners may have little or no value. At this point, it is very useful to review some terms that are included in this lesson, and also very important in daily life for many people. A loan principal is the amount of money that is loaned and must be repaid. Interest is the additional fee that the borrower must pay the lender for use of the borrowed funds. Annual percentage rate, or APR, is the 1-year rate that is charged for borrowing, expressed as a percentage of the borrowed principal. Now we review the second way to raise funds: working capital and unsecured loans from banks. Firms need current liquid assets available to meet short-term operating expenses. The ability to meet these expenses is measured by working capital. The equation working capital equals current assets minus current liabilities. Positive working capital means the firm's current assets are large enough to pay off current liabilities. Negative working capital means the firm's current liabilities are greater than the current assets, so it may need to borrow money from a commercial bank. An unsecured loan occurs when the borrower does not have to put up collateral. Usually, the bank requires the borrower to maintain a compensating balance or a portion of the loan amount on deposit with the bank. Now we will move on to the third way to raise funds: angel investors and venture capital. Angel investors are outside investors who provide new capital for firms in return for a share of equity ownership. Angel investors typically expect a sizable piece of ownership in the company or a formal say in how the company is run. Venture capital is private funds from wealthy individuals seeking investment opportunities and new growth opportunities. This video shows you a brief comparison of angel investors and venture capitalists. It also explores which would be best for you as a business entrepreneur. A corporate bond is a formal pledge obligating the issuer to pay interest periodically and repay the principal at maturity to the lender. The federal government also issues bonds to finance projects and meet obligations, as do state and local governments. Again, since we are introducing the new topic of corporate bonds, I wanted to take a moment to review some terms. A bond indenture is a legal document identifying the borrower's obligations and the financial returns to lenders. The maturity date is the future date when repayment of a bond is due from the bond issuer. Face value, or par value, is the amount of money that the bond buyer lent the issuer and that the lender will receive upon repayment. A bond is in default if the borrower fails to make payment when due to lenders. Bondholders can then file a bondholder's claim, which is a request for court enforcement of the bond's terms of payment. When a financially distressed company cannot pay bondholders, it may seek relief by filing for bankruptcy. To aid investors in making purchase decisions, several services measure the default risk of bonds. Low-grade bonds are usually called junk bonds. Negative ratings do not necessarily keep issues from being successful. Rather, they raise the interest rates that the issuer must offer to attract lenders. The 2008 recession raises questions about credit rating agencies. Mortgage-backed securities, or MBS bundles, often contain risky subprime mortgages, so investors received little or nothing when the housing markets collapsed. I have created a small Check Your Understanding section, similar to the online presentations, to help you verify your comprehension. You can review the answers on the next slide. Thank you for watching today's video. Please reach out to me via the chat room or email if you have questions. Have a wonderful day.